You have the stream. Should be live. Digital. No digital. Let's see. Like I said, I'm just looking right now. I don't know if it's actually going to happen or not. But okay. So Monday night strat session, December 11th, 2023. We're going public today. See if there's any extra people here that want to submit charts or ask questions. I said earlier today that tonight's topic of discussion, we're going to have a kind of a round robin style, just a few things I want to touch on, and we can go through some scans and just get some charting work done. If there's anything in particular you guys want to go over, feel free. But for the most part, the stuff that we're going to talk through, I want to try to keep it to Thursday's session, because Thursday's session, the mid-monthly charting session, is going to be an incredibly important session as it sets up the last 2 weeks, obviously, of Q4, but we're also already starting to look into the beginning of Q1, right? So we've set ourselves up for an incredible run that could potentially continue into 2024. I guess the first thing that I want to talk about, and then we'll kind of, like I said, go into like a round robin style of questions and stuff, but is looking at the indexes and what we were kind of thinking when we were going along, right? If you think about it, back in late October, early November, it was incredibly difficult to try to get long with any sort of real confidence, specifically until we got up and over the 200-day moving average. So I routinely talk about inside of Discord, and we routinely look at some of the, like, for example, the monthly charting session that we had on this specific day, Wednesday the 1st. And we're talking about, listen, this is a fantastic rally off of the bottom, but we're not out of the woodwork yet. If you remember, there were a lot of conflicting data points that were coming out as to say whether or not that was the absolute bottom on the 27th. We had that really popular chart by Ryan Dietrich that came out that said, hey, the 27th is historically the low prior to the run up through Q4. Shout out Ryan Dietrich. That ended up being absolutely right, whether or not that's coincidence or not. I think there's a little bit of both there on that one. But we're looking at a bunch of different things. And while we were taking that into consideration, we were looking at AMD, right? So on the 31st on that Tuesday, after hours, you guys remember, AMD had earnings. And post-earnings, AMD gapped down 5%. And this was just right on course for what we had just been dealing with from the late July through end of October lows, that corrective phase, that 10%er on most of the major indexes and a lot more on individual stocks, right? So what happened with AMD's ER? We talk about this all the time. What matters more than the ER is the market response to the ER. And so we're already kind of thinking to ourselves, like, was that the floor on the 27th? Well, here we are on the 31st of October. AMD, big gap down. This is obviously a somewhat important semiconductor stock, U.S. domestic at that. And all of a sudden, we're down 5%. We're down here hitting new lows after hours. And we're going, well, shit, that's not what would be indicative of a market that is looking like it wants to bounce here, right? We were sitting here talking about it, trying to think logically through this. But then what happened? By market open the next day, we were back at break even. And then the very next day, obviously, as you can see, we were up nearly 10%. There was a 15% swing with that ER event. That is indicative of a potential pivot and new highs. So we took that into consideration when we were going back to that monthly charting session, right? We were looking at that on the 1st of November, and we were going, that's different. The market has not done that for 3 months. So now we're starting to get a bunch of different ideas here. You can see that we had a bullish divergence playing out across the RSI, showing that momentum was waning into the lows. We took the AMD trade ER and we ran with that. We didn't actually trade it, but that was built into the thought process on whether or not we were going to start going long. And lo and behold, the very next session, we gapped up and over the 200-day moving average and closed on a very strong candle. And that was the green light. We started grabbing positions on the 1st of November and the 31st, by the way. We'd already gotten long Microsoft. We'd already gotten long Meta. But a gap up and over the 200-day moving average, as bullish as a candle as this is, we took that as a fuck yeah, time to get in. And we did, right? We did. We got into a lot of positions early. And most of them have worked out very, very well. So now we're stuck with the realization here. I want to touch on the difference between the Qs and SPY really quick after this. But we are very close to an all-time high. We bring this down into the line chart. Talking about this at the end of the session today. But look how close we are from a closing perspective to all-time highs. Just click and drag. Less than 3.5% away. S&P 500 right now, less than 3.5% away from the all-time highs. And people are still calling this a bear market rally. Let them. Their liquidity is needed to get up and over that 475 to 477 area. Let them do what they need to do. Thank God that we have idiots with 100,000 plus follower accounts on FinTwit that are still suggesting that this is just the next leg up before a new bear market, etc. New lows are incoming, whatever. But we're 3.5% away. But look at the Qs, right? It shouldn't surprise anybody in TTI, and if you're out there watching this, because the Qs have outperformed everything, right? We're about less than 2.5% away from all-time highs in the Qs. Mag 7, by the way, led most of the year. People wanted to use that as an excuse to not get long. Breath sucks. The markets are only up because Magnificent 7 is carrying the market. Maybe you're right. I don't think you were, but they have definitely outperformed. But now we're staring at a realization where the Qs are less than 2.5% away from market, from all-time high, rather. And if you look at this, Mag 7 was red on the day, and the Q still closed up. What does that mean? If your argument for not getting long earlier this year was that only 7 stocks were pushing the indexes higher, well, now we're in a situation where the Mag 7 was actually bringing the markets down, but there was so much bullish price movement under the surface there, market breadth expanding. Specifically, you look at these QQEW, or equal weighted Qs, that the rest of the market was actually propping up Mag 7, and it was still up. So if your previous idea there that the market can't go up constructively if it's only the biggest 7 biggest stocks in the market, well, now what? Now where is your bearish thesis now that the market can't continue to go up because the Mag 7 are going up? You got to pick and choose your battles here, and I think you're on the losing battle here if you don't think the Qs specifically, but I think the overall markets are going to be at all-time highs within the next 4 weeks. I think you could be there by Christmas. I don't know if I want to go out and stake my reputation on that. I know that's a bold call and probably get me a few followers. We're trading it like the market's going to be at all-time highs within the next 4 weeks. Look at the Dow Jones Industrial. Dow Jones Industrial right now, I think, is closer than all of them. If we just shift-click up, we are less than 1% away from an all-time high. And I don't know how old you specifically are, but I've been trading for coming up on 15 years in February of next year. I'm not the oldest guy out there, but I got a couple years under my belt. The Dow Jones is what every boomer is focused on. The Dow Jones is, in my mind, the most important index out there in terms of overall market health, overall market sentiment. Reason being that the Qs obviously are overweight tech with comms and consumer discretionary in there, but so is SPY. SPY is 20-something%. Their tech is 20-something% of SPY. What's the largest sector in the Dow Jones right now? I think it's financials. I think the top 3 are financials, industrials, healthcare, and tech, top 3 or 4. There's a lot more variance within that Dow Jones Industrial. So what is it telling you right now? If we're less than 1% away from a closing price of all-time high in the Dow, it's telling you that the broader market is now participating in this uptrend. It's now telling you that this bull market is now coming to full fruition and full strength here if a majority of the market is now pressing up into new highs. And we're also getting a lot of strength, finally, from small caps, and they haven't even broken out from their range yet. We have this idea that we're trading, obviously, within TTI called the January effect. Historically, small caps and mid caps start to outperform the beginning to middle of December through January. Now, what are we seeing? Small caps and mid caps are rallying the hardest. So there's an opportunity there, right? If you look at the absolute Florida where we're at right now, it's up 16%-ish. 16% in small caps. We're just right over the 200 moving average. We're not even up near range high yet at 200. Could we be there within the next 4 weeks? Absolutely. Kick in the January effect, and yes, we probably will be. But what are the ramifications of the market if small caps break their previous area of contention that they haven't been able to get over for the last 2 years? Is that indicative of a complete risk-on environment? Could be. We tend to think so, right? It's all about sector rotation, market cap rotation. Where is a majority of the opportunity lying, which kind of segue us into the next portion of conversation I want to have. Costco's at all-time highs. Obviously, we've been looking at this chart a lot. Great setup from a TA standpoint. Really nice move today as well. There's no reason why you can't trade this as long as you have the expectation that it might be an underperformer, and that's crazy for me to say because look how bullish this TA looks. This is almost a 2-year long ascending triangle breakout into all-time highs. Of course, you should at the very minimum be looking at this. And if you want to grab a position, feel free. It's not a bad way to diversify against higher beta stocks, but that's where the problem lies in and of itself. Yes, this is a potential 2-year ascending triangle breakout with an ER catalyst coming up, which could absolutely propel this higher. But if you shift click from 610 up to about 735, which is the price target based off the fib extension, it's a 20% move. Now that's great. Don't get me wrong. 20% is awesome. But when you take into consideration that this particular stock moves 1.3% ADR, meaning from peak to trough, any given day, this thing will move 1.3, and it's only an $8 ATR on a $623 stock. That 20%, assuming ER doesn't kick this up double digits, which it could, this is kind of a market where it might, but if it doesn't, this thing could take 3 to 4 months to get up there. 20%, 3 to 4 months. Go out onto the options chain and look at how much that's going to cost you to buy that much time for that price target. Not saying it's a bad idea, but from an opportunity cost standpoint, let's look at something like the Sentinel-1 trade. Now, I'm not sitting here saying that Sentinel-1 is any more bullish than Costco from a TA standpoint, but what I'm telling you is we know that tech, software, mid-cap is in season right now. Like, this is where all of these stage 2 breakouts are happening. All of them are happening within this specific demographic. Small and mid-cap software stocks are breaking out in tandem. We have GitLab, we have Sentinel-1, we have like a slew of them. If you scan through these on any given day, you're going to find a bunch of them. Now, these are higher beta at 4.28 or $1.13 on a $24 stock. So obviously these things move a lot more. So from an opportunity cost standpoint, you could buy Costco at the all-time high. It's a nice setup. It's easy to read. You know exactly where you're right and wrong. Might take you 3 to 4 months to get 20%. But our Sentinel-1 entry off of the 23 pivot is going to offer a 25 to 30% move. And this is already almost halfway through. It's going to take us on a 4.28 ADR maybe a week or two to move 20%, statistically speaking. So from Costco's 20%, meaning needing 3 to 4 months to manifest, a highly volatile mid-cap software stock breaking out might only need 2 to 3 weeks. So from a trading vehicle perspective, where most people get this wrong, you'll see on FinTwit, everybody's going to scan for symmetrical triangles, ascending triangles, descending triangles, whatever. And then they're going to post 57 charts showing all of the same setups. Congratulations, you're a 5-year-old and you figured out a puzzle book. But if there's 57 symmetrical triangle breakouts, where's the back-end process that shows you which symmetrical triangles you should be buying? Because you probably don't have an unlimited money trick. Robinhood phased that out. So you can't buy all 50. They're all going to have different expected values. So you need to be able to fine-tune that filter set to find the highest expected value out of that symmetrical triangle. In this case, we're using a basic volatility function to weed out which stocks would we rather be trading. So from a trading vehicle standpoint, would you rather own Costco for a 20% move over 3 to 4 months? Like I said, totally fine. Or would you rather own a higher beta software mid-cap stock that's going to give you the potential for the same price movement over a 2 to 3 week period instead? There's risks associated with both as well. I'm not going to get into that. But from just a pure stock selection process, when the market is giving you higher beta names in droves, you should be looking to trade the higher beta names. My idea here is that Costco is probably going to be a winning trade. I love the setup from a TA standpoint. But is this the most effective place to be pushing your limited and finite capital into? That's the $1 million question, right? So if you're inside of TTI, you have to hear me talk about this all the time, but it's just something that most people are never going to think about. They're just going to look at a shape on a chart and they're going to run with it because, hey, they found a shape. Good job. It's a shape. Two other things I want to point out here. Semiconductors all-time high close today. We had asked many times, was this a top or a pullback? Obviously, we said it was a pullback. We stayed long this specific industry through ARM. We have a couple guys that are in AMD. We have a couple random guys that are in other positions as well. But that was, in fact, a pullback into previous all-time highs and a bounce into new all-time highs. From a sector standpoint, we have XLK. XLK is breaking out into an all-time high. Same sort of idea there. Was it going to be a pullback or was it going to be a top into new lows? And if we actually go and we look at Koyfin really quick, I want to point out what XLK at all-time highs. Look at what's leading right now. Let's go back over the last month. Wish we could do it a little bit differently, but you can see the largest companies by weighting are obviously Microsoft and Apple. It's the same thing as the Qs, but when we look at the 1 month return, look at that. Enphase of all companies. Enphase. Right? That was a semiconductor stock that got absolutely slaughtered. And if you look at the chart, it still doesn't look great, but that is the sector leader over the last month, clearly showing that the market is trying to find a bottom. Skyworks, Keys, Palo Alto, there's a trade that we're in. CRM, ON. You could see the types of moves that have been made over the last month. This is an all-time high. For people to sit here and say that the market is bearish or that they're looking for new lows, I just don't see it. We can also go into SMH since we were just talking about it and look at some of the performers within the semiconductor space. First, looking at weighting, NVIDIA, TSM, AVGO. AVGO up 10% today. Constitutes the third largest weighting within SMH. We go through returns. A lot of names here we're looking at. Skyworks, NXP, ON, Monolith. Obviously, if you're inside of TTI, you know that our main focus right now in semis is this ARM play, which we've successfully been able to add. As of today, I did not, but a bunch of people added their third ARM position on the pullback with the BRB. So an opportunity to continue to get long ARM. It looks fantastic. This is our Big Blue Skies breakout setup that we've taken to capture that bullishness with not only newer IPOs, which are being bought right now. We're seeing lots of stage 2 breakouts off of recent IPOs. As you can see, we have a couple here. We have GitLab, recent IPO, stage 2 breakout. Snow, a little bit more trading history, but recent IPO, potential stage 2 breakout. You can see the kind of idea we have here with these things. ARM is in that group, even though it has not traded as long. Recent IPO, stage 1 into a potential little stage 2 pop-up. So we've been able to take advantage of the semiconductor bullishness through this. The idea within TTI is to identify, obviously, sector, industry, market cap strength, and then find the stock to best capture the price movement, right? It's not the other way around how most other traders or most other groups focus. They focus specifically on one setup and then find the stock that has that setup. We focus on the macro idea first and just plug whichever stock we think is going to be able to allow us to express that macro thesis the best. So, a couple things we touched upon there. Are there any charts or any questions? Feel free. I think I can see most people. This is public right now, so there are going to be questions that aren't in Discord. If I don't see it, I apologize, but I'm going to try. So if you guys have anything you want, obviously, if you're in TTI, you have precedent. Feel free. Go ahead and ask. Charts, trading, questions in general doesn't necessarily have to be what I think about specific setups. What do we got here? A hot topic for today was about stopping out of options contracts. We'll touch on that afterwards. Let's see. Pat says CTSH. If you're in TTI, obviously, I want you guys to be posting your own charts, but I know Pat is. I bully the guys that pay me. It's in good faith, though. The goal is to try to get these guys to be able to do it by themselves eventually, and most of them get there. Tech name, large cap. So what's the one problem with something like a CTSH right off the bat, Pat? Comes back to that opportunity cost idea. Large cap's fine right now. There's no reason to hate a large cap, but the fact that it has a 1.41 ADR means that maybe this is just not the best trading vehicle to express what we're trying to do. Once again, it looks like it'll probably work. I see the horizontal level that you're looking at. I don't love the volume above it, but it's a simple fact that it's probably just going to move really, really, really slow compared to everything else around it. And so right now, in a market where higher beta stocks are really getting a lot of this flow and they're breaking out, you're doing, just for everybody, you're doing yourself a disservice by trading lower volatility stocks. So if you're using ADR, our threshold is at least 3. So 3% or higher within your ADR is going to give you an opportunity to capture higher beta stuff. But right now, specifically with something like ARC pressing up in towards a potential overhead resistance and a potential stage 2 breakout, watch your ARC. You don't need to trade ARC itself, although you can if you want, but this is indicative of a different type of environment if this gets up and over $51, $52. The market is going to be buying higher beta shit stocks again. And so if you're stuck owning something like Cost, which moves at 1.8, or CTSH, which is like 1.9, yeah, you might win because we're in a market environment where almost everything is going to go up, it feels like. but you're going to be trading something that moves at like 1/5 the volatility that something else does. And if they're all going up, as a trader, you should be focused on the thing that has the higher chance of going up more. So let's focus on those higher beta stuff. It's still a good chart. I appreciate it. Just following along, setting stops. If the stock is in a steep ascending channel and too far above the 10 DMA, what would you use for a stop? So I know we talked about this at the end of the session. If you're going to use the 10-day moving average as your dynamic support, I would just stick to your 10-day moving average. If you start implementing rules around that all at once, you're going to mess something up. So what I do is I'll show you on the charts here. We can use something like a Sentinel-1 because I thought it was going to happen today, but it didn't. So let's say we enter off of the $23 area. This is for shares, by the way. And we're opening off of the $23 area just to keep it simple here. What I would look for before, obviously our stop was right below Thursday's. Let's go ahead and paint the picture here. Right below Thursday's low. And our take profits way up here. So this was up 4, 5, 6 to 1, depending on where you're able to get filled. I think most people got filled actually near 22.5. So this was just for illustration here, this was a massive position to be in. So like a 10 or 12 to 1 R. It's a really good opportunity for us. But we'll just go ahead and put it back at that $23 area. What I'd be looking for before I move my stop up from the original stop at 21.88, as in this example, is a 2 times ADR move. So I'm looking for something like an 8.5, something around there, percent gain profitability off of the entry before I move it up. So 23, I shift click up. Are we up there? I thought we were going to get up there today. As you can see, we were pretty close. We pulled back. So what I would do is wait for that 2 times ADR to get up there, and then I would immediately come up and cover my stop. And the reasoning is because I want to give the trade the opportunity. I don't buy in, first off, to don't ever let a losing trade or don't ever let a winning trade turn green. It's such bullshit. It's mathematically fucking stupid. Like I saw a tweet today that said, don't ever let a 20% trade turn red. Does that make sense if you're trying to capture like an 80% move? Why is 20% the imaginary number? That don't ever let something that hits 20%? Doesn't make any sense. It all comes down to your risk to reward. What happens if your goal is 80%? What happens if your goal is 100%? Does 20 matter in that grand scheme of things? No, this is like a bump in the road. If you get up there and it comes back down to break even and you go back into the red, that's part of business of trading higher risk reward setup. So this 20% rule, arbitrary, doesn't make any sense. So what we're looking to do here by covering your stop with a 2 ADR move is to give the trade enough room to breathe, first off, and then move your stop up logically based off of normal volatility days. So for example, this specific stock will move 4.28% intraday. If we get if we get 2 or 3 volatility moves up and over the entry, you can come up and you can reasonably assume that at this point you're outside of a normal volatility day coming down and wicking you out. If it comes down and stops you out, it's probably because at this point it's a false breakout. If it pulls back slightly 1 ADR and continues, you're covered. You don't need to worry about it because you're going to stop out at break even. But it absolutely can pull back in an uptrend 1 volatility day, and you don't want to get stopped out on that. So I normally run the rule of 2 ADR moves above your original entry before you cover, because I want to give the trade enough wiggle room to pull back without getting stopped out prematurely. And then once we're up and over into an entry, we've talked about this a few times. There's a rule that I have employed that has worked very well for me, but when we get a 2 or a 3 times ADR move, so in this case it would be a 2 or 3 times force, so we'll say anywhere between 8 to 12% in a single day, I automatically and aggressively move my stop up. I don't want to say arbitrarily, but it's discretionary. We're discretionary traders. It's generally underneath a previous candlestick or the day's low that we hit, because this is outside of a normal day. Right? We can all agree that if you're moving on average 4% and all of a sudden you get a big gap up into a 12% move, it's either going to be an exhaustive momentum move to the upside, a blown off the top, or an opportunity to aggressively move your stop because some sort of catalyst came out and now the stock is off and away, and we should be moving our stop up incrementally anyway. So if we're up 2 to 3 times ADR per day, we're going to want to aggressively shove our stop up in case it's one of those momentum ending blow off the top type of candles. We want to try to capture a majority of that without giving it back. On any sort of normal volatility day, what I do personally, some people like yourself are experimenting with moving average pullbacks. I incrementally move my stop up on every single green day. I'll incrementally move it up. And then if it's a red day, I just leave it alone. Now, this isn't perfect. Either is a moving average, either is a volatility like a chandelier exit system. None of this is perfect. You have to experiment with what you're able to do. But what I have found is that when I use dynamic support for pullbacks, I would prefer to add there than stop out. So if we're in an uptrend, what's a stock that's maybe Shopify? Here's a stage 2 breakout on Shopify. Now, obviously, this is the 200-day moving average. We get the big gap up. We'll consider this the original breakout. If you were using any sort of short-term moving average on here to stop out, you would have been stopped out very, very quickly post-gap up. If you used it as an opportunity to add in, potentially you could have made a couple bucks and you probably would have still been stopped out, but I'm just trying to illustrate the point here. If you fall below some sort of short-term moving average, most people are immediately going to assume that the trend is broken. I mean, in reality, who's to say the 10-day moving average or the 9-day or the 11-day is any better than a VWAP? You could use an anchored VWAP or a 50-day. It's just something that you need to figure out that you can stick to emotionally, which is the big point here. Buying against dynamic support retests, in my mind, is a better idea than stopping out. But if you want to place a stop underneath those, that applies as well. So it's not just a one answer fits all. I do it completely different. I don't think what you're doing or what you're exploring with is wrong. Like I said earlier today with you, I think dynamic support offers a decent opportunity and a good visualization for you to be able to place your stop. And I know lots of people do it. It all comes down to your risk tolerance and being able to actually execute it. JXN. That first rule, though, with the 2 to 3 times, the 2 ADR rule off of your entry is a great way to cover your initial risk in a shares trade, though. Obviously, from an option standpoint, it's a lot easier because we could just close half at 100%, but shares are a little bit more tricky. Yeah, so this is a name that we actually traded off of this breakout. Dustin and I and a couple other guys grabbed it. Wasn't really that great of a trade. Ironically, if we shift click up, you can see that it did move quite a lot, but we fumbled this the first time we were opening it. So you can see this is just like the ARM idea. We're just looking at IPO range breakout highs. This is our patented Big Blue Sky breakout. This is a financial name. Says insurance. I don't know if it was insurance when we were trading it or if we even knew it was insurance at the time. It just recently IPO'd, but 2.66 ADR is on the low side and 759,000 average volume is on the thin side. Something to consider. There's 2 yellow flags. I wouldn't say red flags because this is pretty goddamn close to a 3. And we're pretty close to 1 million. But I would assume, and I can actually go ahead and double check this, that the options chain is probably not going to have very much. And yeah, there's nothing. There's not going to be a whole lot of action on the options chain. And you can already kind of tell that because the volume is below 1 million. That's why we have that million average volume of 1 million filter on. So we can kind of dig through some of this crap. Not saying that JXN is a bad trade here, but we can dig through from an option standpoint and be like, maybe this is not going to have a whole lot of options availability. So we can just overlook it. From a Big Blue Sky breakout, though, I mean, you got everything that you want, right? Tom, I mean, you got all-time highs. You got the financial area. We know that financials are starting to pop out. So, yeah. I think if we just draw a basic fib extension off of this, we can get some decent ideas here. Doesn't have to be any more complicated than this. 49.5 or 50. 50 cents isn't going to change a whole lot. Target the fibs up. 65, 90, etc. Nice little setup. I'm going to tag Dustin in that tomorrow. I appreciate you showing me that. Yeah, it's another TPG, right? Just so everyone's aware. Tom's in TPG. He's the first one to grab this. Nice little, once again, it's a little bit slower of a mover, but it's an all-time high type thing. Not an all-time high, excuse me. We came up here and tested this, but we talked about this extensively of how this didn't matter because there was no volume associated with it. But this is a nice little trade. It's almost literally the same thing. 787,000 volume is paper thin. 2.58 ADR. And then you're up about 6% on this over a few sessions. So UPST, we'll do Zion right afterwards. I'm already in a Zion play, but we'll look at it. Looks like we had already talked. Oh, yeah, we talked about it. It's the same thing as TPG, right? It's exactly the exact same idea as TPG. So this is going to look a little different because TPG is already breaking out now, and you're getting some volume associated with the price points on the most previous breakout or on the most recent breakout. But back here, there was like no volume, Tom, remember? So we were looking at this and we were like, well, should we focus on owning this thing above 45 or should we focus on owning it again above 35? And we had a constructive conversation about how many real buyers were up here. And we could actually verify that by looking over here at the VRVP. Was there substantial amount of demand up there last time that could potentially act as resistance, right? Were there buyers up there that are now looking to potentially just get out of break even? And there wasn't really. There was really no volume up there. We just saw a subsequent pop on ER and then a die back down into the range. And so we said, fuck it, let's just own above the 35.5 area because there's probably not going to be a lot of overhead supply. UPST, somewhat of the same idea here. If we look over to the right, there's really not a whole lot of volume over here at this price point. A majority of it is within the accumulation zone, right? So this is a stage 1 accumulation, has the patented V. You can see financial institutions have their footprint on UPST. So I think it's the same setup as TPG in that regard. I'm going to go ahead and remove this because it's ugly. But own this thing above 35, currently trading 35.80. I don't think it's the most bullish name that you could be owning right here, but it's not bad. The chart itself shows that above 35 is pretty good. Volume is paper thin up here, so I don't think there's going to be a whole lot of overhead supply that you have to worry about. It's a mid cap, a lot of volume. It used to be a meme stock. I don't know if it still is, but follow the fibs up, and I would probably run a tighter stop. Let's look at the chain really quick at UPST just to have a general idea of what we could be working with here. I'm assuming it's a really high IV. Yeah, it's a really high IV. So this is a call debit spread right off the bat, 109 IV, or you're selling premium to get long. 27.7 IV rank. So somehow this is on the the lower IV side over the last 52 weeks. Let's go out to March. Go back to the chart really quick. And we're looking at like a $50 to $55 price target. Let's look somewhere there. I think that'll probably be a better idea. So 50, 55. Look at the deltas on these things. I don't know if this is going to be the best trading vehicle. The 50-55 call debit spreads right now, $76 for a 424 max profit. There's no chance we want to get long on straight calls on this. And call debit spreads, man, let's see if we can tighten this up a little bit. Maybe we can go 45-50s. I don't know if we will. Is there a 4-to-1 setup here? There is. Look at that. It's a 4-to-1 setup on the 45-50s. I'm surprised. I don't know if we're going to get that tomorrow if there's any sort of push to the upside, but I'd be looking at something like that, the 45-50 or the 50-55, get into a call debit spread or sell premium to get in. You can see that there's obviously buyers here. It's not my favorite setup. I think the contracts are super juiced. I think the shares trade is going to be easier than a contract trade, but there is a play here available if you want UPST in March. It is within the right area of the market. It's a mid-cap software name. We know we want that. And I said we could tighten up the stops. We've already starting to break out above 35. So if you really want this name, let's just use 35 as the entry. Let's assume that for whatever reason it does pull back slightly. The original stop would be at 30.02, but because we're buying it on a pullback after it's already broken out, we can tighten that stop up to underneath some sort of candlestick that matters. In this case, it would probably be, is it the same Thursday low? I'd say the same Thursday low right off the bat. So we're skewing the risk to reward from about a 3-to-1 setup to a 5 to 5.5, depending on where you're able to grab this if it does pull back to 35, by using Thursday's low as your stop, assuming, and it's not just arbitrarily throwing it back there, right? It has to be a rhyme and reason. What makes sense here is where they're going to break out from this base above 35, which we've obviously contested multiple times over the last few months. What we don't want to do is hold this thing back within the range, which would essentially could potentially send us back to $20. Who knows? I don't think it'll happen, but it could. So if we close below Thursday's low, it's a failed breakout, at least within what we're looking for. And we're looking for that $49 to $50 area first price target. So I think it's a better shares trade. At an 8.96 ADR, I think there's a lot of juice to be had out of the shares trade. So Dylan asks for Zion. So we're already long some regional bank names. Right, really quick just to show, we're long Key. Obviously, I posted about it a lot, but we're long this Island Reversal Fractal breakout. We're looking for a high and tight breakout here, which could be happening within the next few sessions. Continuation play up towards a potential gap fill near $15. We really like that. And CUBI is another trade that we've just started initiating on. You can see the play here. It's less bullish in my mind than Key. The overall stock has performed better than Key, but the TA behind it, not as much. But this is one of the bigger yearly winners within the regional banking space. And so there's an opportunity for us to be able to grab this. We originally wanted it off the 46.5. We didn't grab it, so now we're looking at the 49.5 area. For Zion, this is a play that I actually bought back here on this Island Reversal free trade. And so I covered a majority of my position on the pullback and left a few contracts on there. And they are, I believe, positive again. I have some Januaries that are positive again once Once again, so I'm looking at here, Zion. I mean, risking 39, I suppose, something like this. The whole point, though, is that profit target. From a 38 or 39 area, do we have enough juice in the tank to get up here towards that 45 area? Man, I don't know if you're going to be able to find an options play that makes sense here. The one thing I don't like about all of these regional banks, obviously the 200-day moving average is sloped down. So if you can find some sort of regional banking chart or banking chart in general that's either flat or starting to slope up, obviously price has been trending in the right direction for longer than not, and we like that. 3.59 ADR fulfills that function. We do have a volume gap up here towards about $49 to $50. There's really no volume up here whatsoever, which is nice to see. Bullish momentum regime. So this is a green lit trade, obviously. It's just, can we find something on the chain that makes sense? One more time, price target somewhere between 45 and 50. Go down to the Aprils. We like that 0.25 delta, which is the 47.5. Don't think we'll get a 4-to-1 here. Well, before I even do that, this is something we want to juice. We want straight calls. 55.4 IV with an 8.5 IV rank. We don't want to pigeonhole ourselves into a call debit spread because this is a prime candidate for IV expansion. You buy call debit spreads, you're not going to be able to capture that IV expansion in the premium. So if you can afford it, I would go with straight calls. I actually don't. I usually hate the in-between contracts, but this actually has a lot of volume. I'm surprised. 0.25 delta is that sweet spot here. So for $1.35, you can get long that 47.5. And if we go back to TradingView really quick, 47.5 is right there, man. I mean, that's like the price target that we've been gunning for off of the 32 area. So yeah, there actually is a play. There's a play here on Zion. The 47.5 calls for $1.35, 0.25 delta, right in the wheelhouse. You have 130 days on these things. Not a bad idea. And the best part about being able to buy these straight calls here is that the theoretical profitability on these are infinite, right? You don't have to close until you're forced to based off of theta, which is nice. If you're playing this specific setup here, you can just draw some sort of fib extension to get a general idea for risk, which it makes sense, right? Profit target's up there near $46. You grab the 47.5s, you can let them continue to run, and your stop's going to be underneath this consolidation fractal right here. Makes total sense. I probably wouldn't buy until we're above 39, though. Currently trading 38.63. So nice little setup there on Zion. I appreciate you calling it out. BKD. Nice. I like that. I know you double checked the ADR on this one. You're sick and tired of me saying, well, it's not a bad setup, but is it the right type of play? Side note, anybody ever looked into opening an old folks home from a business perspective? It's pretty goddamn profitable. Some pretty goddamn profitable old folks homes. If any of you guys have ever had to had the unfortunate event to pay for one of those, they are fucking expensive. I think our family's paying like $6 or $7 grand a month right now. Like, it's a nice place in the middle of fucking nowhere. I can't imagine if you're forced to have to pay for one in like a downtown area. I'm sure that's fucking like 10 to 20 grand a month. I'm not even kidding. Fully assisted places are so expensive. So BKD Brooksdale, God bless our old folks that have to fucking sit in those, by the way. Some of them love them. Most of them don't. Feels bad. See what you posted on the chart. Yeah, it's not fun. I feel bad every time I go in there. But my relative actually really loves it. Gives her an opportunity to fucking talk everybody. So, yeah, I like your chart. 4.37 ADR. You have your VRVP. You have your RSI. We're post ER, so we don't have to worry about any sort of catalyst coming up here and blocking this. This is what I'm talking about that 200-day moving average sloped up. The other charts within regional banks, this is something that's kind of a problem. So price is above it. You know, I don't hate this chart. I think, though, that from an opportunity standpoint, there's probably just better ones based off of sector and industry right now. Also, you have volume up at that 675/7 pivot, which is going to come into play, which, well, actually, look at that. Another shift click up, and it doesn't matter. I love it when you look at charts right away, and you're like, it's not that far off. And then you shift click up, and you're like, wait, that's 30%. Okay. So that kind of changes things a little bit. I'm assuming you're going to be trading shares in this. I don't know if Brookdale is going to have any options opportunity. Let's go look. I don't even know if we'd want it if it was. Yeah, there's no options availability. Somebody grabbed a bunch of January $6 calls today. 38 of them for about 20 cents a pop. which might be doable, but who's going to want to buy them? That's the problem, unless they just want it to expire in the money. Little high and tight here, though, right? Well, I can't say it's a high and tight. It is a little nice little bull flag. High and tight, remember, for the guys inside of TTI, high and tights and bull flags are both continuation fractals, but a high and tight in particular does not have huge white spaces, and in this case it does. So we're going to call this a little bit of a bull flag consolidation fractal on top of a flag pull, so it's a pseudo high and tight. Your horizontal level is obvious. Where's the price target off of this? I'd probably be targeting the next high volume node up near 650, 675, something like that, which once again is not a bad little trade. If you shift click up and look at the actual price, it's 20 to 25% move depending on where you get filled. So where would you place your stop on something like this? That's where a majority of traders don't want to have a conversation. We'll say nice big round number at 550. Put your stop somewhere below the fractal. Is this even a 3-to-1 setup? Let's see. Barely. So I don't know if this is a good trading vehicle. I know we talk about this all the time, but does that make sense on maybe why it's not? It's not that the TA can't support an opportunity here, but we just went through a bunch of trade ideas that have like 5, 6, 7-to-1 risk to reward, and then this one has like a 3-to-1. So from a stock selection process, is it even worth your time? I don't have the right answer, by the way. I don't know. This thing could end up being the next Grand Slam, but it also couldn't. And I think there's more evidence waiting to the side that there probably is not. If you scroll all the way back, look at that volume node. So there's probably going to be resistance up here that you're going to have to fight through. And if you're grabbing the flag breakout, that's just something you're going to have to fight through, right? So I think there's better opportunities, but the chart's not terrible. TAL. What's up, James? Yeah, no shit, they are. Trade idea that we had. I don't know why my chart keeps doing weird shit like this. I think it's because I'm in log, but this is Chinese, isn't it? So we're just not going to trade this anyway. I'm pretty sure. It's not because I hate the damn Chinese, but it's just that China isn't working. At least not yet. I'm going to double check this on Koifin really quick. Yeah, it's a Chinese-related name, and right now there's just not enough evidence supporting that we want to own Chinese-related names yet, so we're not going to own it. And that's just going to be the end of the analysis there. Because we could also look at something like EDU. Like, this thing is just absolute heater. You didn't trade this? No. We traded it twice, and then China fell off the face of the world in terms of the market, and so we stopped trading stuff like this. This is one of those rare occurrences where, this, for whatever reason, man, the stock has just absolutely blown everything out of the water. PDD as well. So no trading system is perfect. We avoided trading these because of the lack of sector and industry involvement. But in both PDD's case and EDU, these were massive winners. I mean, look at PDD. This is the name to own in the large cap Chinese space. EDU was the name to own at the 1 point small cap space. Now mid cap, potentially large cap coming up. But we owned it off of the 29.5 flip. We sold it up here in towards overhead resistance at 47. And then one of us grabbed a little bit of a piece off of this, but they sold it too early, and here we are. So we're going to assume that TAL is just off the map for right now, since I'm talking about Chinese stocks. We don't want to own this stuff. I was just reading this on Twitter, and I'm going to say this out loud, man. There's going to be a time to own Chinese stocks. Every year there's some fucking rumor about Chinese stimulus and everything else, and everybody needs to own BABA and blah, blah, blah. It's just like, fuck it, dude. You've been wrong for 2.5 years. Give it a break. I'll make it really simple. You don't have to buy the bottom, but at least you're not going to pull your hair out owning this shit that just mulls over and does nothing. Own this stuff when Queb's above 33.5. You're not going to hit the bottom. You're not going to be able to have a movie made about you that you saved the fucking dragon, right? You're not going to be the savior of Chinese equities, but for sure, you're not going to get caught in this nothingness media spin cycle of Chinese stimulus. And like right now, the thing is that the Chinese government is now buying Chinese equities, which is why we saw a positive pop today in Chinese stocks. BABA didn't get the fucking memo, down 1% again today. We're getting the war drums beat on Twitter again. BABA's so cheap, you got to own it. It was, but it was also cheap last October, and look what happened. You round trip the trade. Just don't own this stuff until it's up and over overhead supply. Like I said, you're not going to have an amazing story to tell people, but at least you're not going to blow a bunch of cash. All right, we got 4 minutes. Any other ones? Tom, that was an important conversation to have, though. I appreciate it. For everybody that shares charts, I'm glad that you're doing it. This is why I'm here. And it's an opportunity for everybody to learn this type of stuff. There's a million things that we do inside of TTI that we can't talk about on a day-to-day basis. So when you guys throw this random stuff out, I can pull from that education bank we have on Circle and obviously verbalize it. And it gets it in front of you for the first time. So then if you have questions, you can go look through it on Circle, because I don't know if you've been on Circle, but there's enough fucking material on that goddamn platform to watch for a year. I have 3 years of strategy sessions uploaded. Like, it's fucking crazy. So I appreciate you when you show charts, because it gives me an opportunity to potentially impart some wisdom that I've accumulated by losing a lot of fucking money in my 14, almost 15 years. Check the Twitter. If anybody asked on Twitter, feel free, you guys. Got 3 minutes left. Go ahead, Tom. You got the last one, man. Right now, I don't have very much. I'm very long in the markets right now. And I talk my book. I'm very vocal about that. But I lost on the 3-month drawdown from July through August. I gave back a decent amount of the money that I made from May through July. And I started realizing that I was hemorrhaging a lot of that profitability. And so instead of chasing shorts, if you were in TTI during that corrective phase, we didn't short very often. James, how many shorts did we take over 3 months? I think we only took like 4. Like 4 trades in 3 months that we actually took together as a community. Maybe 5 or something like that. And some of them didn't work. We just kind of sat on the sidelines. So it gave us a lot of opportunity to sit in cash. Yeah, we held off, which, by the way, it's not sexy to market. Like, if people are looking to join a group, they want to make money tomorrow. So if part of the reason why I lock people up here for a year is I'm like, listen, there's going to be times where our edge is not going to work in the market. You just got to sit tight. If you're here with me for a year, you might get mad, but you're going to see why we do it 2 or 3 weeks later when the market recovers. So we accumulated, or we didn't accumulate, we cut a lot of positions during that corrective phase and sat on a lot of cash. And then we started deploying it back in late October, early November. So best decision with our time frame. Yeah, there were opportunities to make some awesome shorts, but I'll be honest with you, most people should never be short. Shorting is fucking hard. It's not as easy as just flipping everything upside down and going short. It's not. And if people want to pretend it is, feel free. There are systems out there that are dedicated to going short, and people are very good at it, and that's fine. But most traders should be long biased with time. That's it. I mean, that's the secret to the market. If you go on FinTwit right now and you read all of the stupid assholes complaining that the market only goes up and the Fed's saving the market, all you have to do is just buy long and don't do anything like an idiot. Great, then do that, dipshit. Fucking do it. If it's that easy, stop shorting the market at every local top, you dipshit, and buy the dip and enjoy the ride. But they won't. They won't do it because they'd prefer to be right than paid. So cash is a position. It's such a stupid thing to say, but it's totally true. Most people can't do it, man. They're addicted to clicking buttons. I'm glad that you guys in here, unfortunately, have to listen to me. I will save you money in the long run by telling you that what we're trying to do in here won't work in whatever market environment we're in. Just sit on the sidelines. You know what some guys did? They just went to shorter time frames, like Mike and Billy and Brian. They were trading intraday SPY stuff like a few times a day, and they weren't making huge money, but like a couple $100 here and there a few times a week, that adds up, right? You can add it back into the account, but it's just something to keep you mentally engaged. 15% is totally fine. It's an arbitrary number, to be honest with you, Tom. It's whatever you feel most comfortable with. But yeah, I mean, 15%, as long as you have some dry ammo. And then when I think the more important question is, how do you know when to let the foot off of the gas and when to press it down? I think that's the most important part. And you'll learn that. I mean, you're already kind of seeing it right now. We're preaching about it right now. This is the time to be pressing the fucking gas down. We brought this up. Who said it? Let me look. Billy. Billy said it again on December 1st, and I think we actually said it before that. He said, I don't know about you guys, but the market feels like April or May again. And for those of you that were here in April and May, it was a max long environment. You could not go wrong. Buy everything and wait. Here we are, almost 12 days later, but I think we brought this up in one of our strat sessions as well, because I think we said it again in November, This is the time to be taking advantage of the quote unquote easy market that everybody's complaining about shorting. The market can't go down. Yeah, okay, then go fucking long and wait. That's what we're doing, right? So push the gas down. Remember, the market moves in spurts. A lot of the time, the indexes aren't really doing anything, and then all of a sudden they do a lot, and then they don't really do anything, and then all of a sudden do a lot. When the markets are doing a lot, you have to be able to be ready to attack it. So if you have some extra cash on the side that maybe you're willing to deploy in those types of environments, that's the time to do it. But then just as equally as important, you have to know like when, you don't have to time it perfectly, but you have to know what to look for in terms of taking the gas pedal, taking the foot off the gas pedal. And we do that reasonably well in here by using like simple concepts like divergences, seeing the loss of momentum into new highs. Volume doesn't really matter to us. As a swing trader, volume matters less in my mind than like what a day trader or a scalper needs. You need volume there to push it intraday. From a swing trading perspective, we don't need a lot of that volume because most of our moves come after regular trading hours, right? And fucking no volume there that we can equate for anyway. And so how can we find when is the right time to take our foot off of the gas pedal? We look through divergences, so loss of momentum into new highs, loss of enthusiasm and sentiment through different reports, the COT, etc. But also a big one is just basic Dow theory. Look at the divergences across indexes and individual stocks. Something that nobody I fucking know, except maybe some of the old school CMT guys, does. Something that we did, back in 2021, the strat sessions back in November, we shorted IWO. I'm going to post the chart really quick. We shorted IWO back in November of 2021 as the first real short. And let me go ahead and get rid of these absolutely atrocious boxes here. This is small cap growth ETF, just for everybody that's listening to this that can't see it. That was our first real short after the 2020/2021 run. We were like, listen, the market doesn't necessarily need to lead through small caps or small cap growth, but there is a problem when small cap growth is breaking a base. Generally, that's indicative of something bigger coming. This basic idea of Dow theory of conflicting indexes moving in different directions might be a yellow light, saved our fucking ass. We closed a majority of our fucking long trades because of this and started looking at potentially going short. We weren't the first ones to do it, but we were definitely not the last ones holding the options and the shares trades into fucking big losses like every other asshole was. And it also saved us back in October of last year. We weren't the absolute first to buy the bottom, but we stopped shorting in fucking November, right, guys? We started looking at longs in December. We were going long in December. And then obviously we bought NVIDIA in January. So it's just like, we're never going to time the absolute top or bottom, but knowing when to take your foot off is just as important as when to put it on. So, good question. Or just talk in general. It wasn't me. It was a full total group thing. That's why I'm super proud of everybody that's in TTIs. It's such a stupid fucking thing to say because Robinhood and everybody else has really made it like fucking cringe to say, but we have a really good, we've democratized this idea process that we do on Sundays where everybody has a little bit of say in everything that we do. And I trust a lot of you guys have been trading with me for now 4 years. Some of you guys have been with me for 4 years. I don't have to do anything. You guys can go off by yourself. You're still here for a reason. So we collab on this shit. And a lot of the times I get second opinions that completely conflict with mine, and it takes me a second. I got to step back and think about it. And a lot of times I'll shift the way that I look at things specifically because the guys in here have been doing it for multiple years now. I have full conviction that they know what they're doing. And maybe I'm tunnel visioning into something. Maybe my bias is not allowing me to see something that I should be able to see. So I have to take a step back. Mike does it all the time. He's like, yo, you're looking at it like this, I'm looking at it like this, and it forces me out of my comfort zone. And sometimes it makes all the difference. It'll completely change the way I look. One of those just happened, 4 weeks ago when we were looking at SPY. I was right in the long end, but he was like, listen, I want to go along with you guys, but I'm going to wait for the descending trend line to break, price to break above it. And then I'm going to go full port long. And I don't know if you guys saw his positions list when he posted it, but he's in like 10 or 11 positions right now. And some of them are up over 1,000%. I mean, he's green on fucking every single one of them, and he's just riding it. And that was just those were the names that he longed off of that descending triangle or descending trend line breakout. So anyway, all right, it's been real. I'm gonna hop off. It's 10 o'clock where I'm at. I hope you guys enjoy your Monday night. I will be on tomorrow morning bright and early We have a bunch of economic news coming out this week, so it should be, I think pre-market we have CPI, and Wednesday we have FOMC if I'm not mistaken. So tomorrow morning will be a fun morning.